We've got the market priced for rate hikes next year. Is that in line with your view of how this is going to play out at the Fed?
Well, first of all, thank you for having me be leadoff batter today on your show. Look, I think the narrative on inflation is a little bit confused. We're talking about what inflation is today, and we know today it's high. Core PCE is high. We know it's going to probably be high in the first quarter, but what we're not talking about is where inflation is going to be in the second quarter, in the third quarter, and in the fourth quarter. The Fed needs to look forward, and the Fed will look forward. So I think the rate hikes are probably that are being priced over 2 rate hikes as Lisa was just discussing, I think is too many. I think, it could be 2. But the point here is that inflation is expected to fall off dramatically starting in the second quarter of next year because the year-over-year base effects are going to be very, very difficult to beat. And in the third quarter of next year and even in the fourth quarter of next year, inflation might be just over 2% on a core PCE measure. So to think that the Fed is going to be hiking rates aggressively into declining inflation, or what may be likely in declining inflation, I think is a little bit of a stretch in terms of what the market is pricing at this point.
Jim, the zeitgeist, and I'm going to give credit to George Saravelis of Deutsche Bank off their foreign exchange desk, is a shift here, a subtle shift from transitory over to macro blather and all the Fed talk and that, over to VAR reality where people are losing money on bets placed previously. Is that what we're seeing?
We are seeing some of that. So there were a lot of curve steepeners that were in the market prior to the big flattening that we saw, and that certainly contributed to it. So I wouldn't cast that aside as nothing. I think that there has been a pretty big shift. And look, central banks have marked themselves to markets. They've become a lot more hawkish in terms of their overall tone. So I think the technicals did play a big factor, Tom.
Right now, we're taking a look at people bringing forward the number of rate hikes that the Federal Reserve will actually execute, not just the timing. And this is a shift. I wonder if this is accurately baked into the rest of the bond market, or if this is just sort of peripheral calls that are trading and not actually bets on the future.
So Lisa, I love your question. If the yield curve is talking, then is anybody listening? And the problem is that not that many other markets are listening, right? So what the yield curve is basically saying is that the Fed's going to bring, or central banks are going to bring rate hikes forward. The curve is going to flatten because the market is not willing to adjust higher the terminal Fed funds rate or the terminal central bank rate. So that means that we're still in a low rate environment from a Fed policy perspective, but we may bring some of these rate hikes forward. So what's happening in high yield spreads? Almost nothing. What's happening in investment grade spreads? Almost nothing. What's happening to equities? Equities are making new highs. So we could say that, well, maybe these markets have it wrong somewhat at this point. But as far as I can say, if a yield curve falls in the woods, is anybody listening? And the yield curve has been falling and nobody else has been listening. And I think this is a very, very critical message in and of itself. This is information too. When you bring rate hikes forward because we're responding to supply shocks that today has inflation higher, doesn't mean that inflation will necessarily be higher and continue to grow. Remember, inflation is the growth rate of prices. We may not be having this at this time next year. So therefore, the market's unwilling to raise the terminal Fed funds rate or the terminal central bank rate. Yeah. So therefore, long end yields, intermediate term yields, or mainly 10-year yields aren't really changing all that much, and 30-year long bond yields have actually been falling. So it is pretty curious right now.
Jim, what do you do then as an investor with this? I mean, basically, do you bet that the market is wrong, and do you sell high yield debt? Do you sell riskier assets?
Yeah, so the answer is not us at Morgan Stanley Investment Management. We still like high yield because the point is that the central bank is going to raise rates, but they're not trying to tighten financial conditions. They still want to keep financial conditions easy, to expand the economic cycle, to continue with growth, to continue to push down the unemployment rate. It's a broad and inclusive goal for the Fed to get all demographics to participate in this expansion. And I think that's exactly what's taking place here. So So the Fed is not trying to kill the expansion. They're trying to extend it, but they may have to address the near-term pressures of inflation with a rate hike or two, and that could be in 2022, but it doesn't mean that they're shifting their terminal rate a lot higher. And if they do, the terminal rate's 2.5%, by the way, as based on the Fed forecasts. If the terminal rate goes from 2.5% to 3%, based on our calculations, the 10-year yield would be somewhere around 2.15%. We're not expecting that anytime soon, but the point here is that the terminal rate matters a lot, and the market is not willing to shift higher the longer-term rate hikes.